is much higher, say closing price, is much higher than the opening price, this suggests that buyers were strong during the trading day. Bar charts therefore provide a richer picture of market activity than simple line charts. Another very popular chart used in technical analysis is the candlestick chart. So typically we use this chart. A candlestick chart originated in Japan in the, say, 18th century, where rice traders used them to analyze market price of the rice in Japan. Today, a candlestick chart are generally widely used by traders around the world because they provide very intuitive visual information about market behavior. Each candlestick represents price movements during a specific time period, such as one day, and the candlestick contains two main parts, the body and the shadow. So these are the shadow, sometimes called the wick. The body here represent the difference between the opening price and the closing price. If the closing price is higher than the opening price, the candle is usually red in Asian market. And if the closing price is lower, than the opening price, the candle is usually colored blue in Asian markets. But in the US, it's the opposite. If the closing price is higher than the opening price, it's blue in US. And when the closing price is lower than its opening price, it's colored red in the US stock market. Anyway, and this thin line shows that the opening price and the closing price is equal. If the opening and the closing prices are the same, the body becomes the thin line. And the shadows, say these shadows, above and below the body represent the highest and the lowest prices during that trading period. Because candlestick chart visually show whether buyers or sellers dominated the market during a given period, many traders find them very useful and used to analyze these candlestick charts. And the candlestick charts are especially useful because they provide a visual charts about the market sentiment. This is the past Kospi stock movement last year. Before it became, it showed a huge increase, and today this becomes about 6,000 points, right? And just before this year, the Kospi were called a box P because they move within a range, say between 180, 100 point, between 2, 500. Anyway, this is the last year's Kospi stock chart drawn from the candlesticks. Say if the closing price is higher than the opening price, the candlestick is usually displayed in red in Korea and Japan, indicating a bullish movement. So as I said, but in US it's opposite blue. And that's why the security firms, investment banks like red colors. So in Korea, they like red colors than blue. So my little advice is to wear a red necktie, and avoid blue for your interview at financial firms. If the closing price is lower than the opening price, the candlestick is shown in blue, indicating a bearish and bullish. We call a bullish or 황소 when there is an upward trend, and we call it a bearish 곰 when there is a downward trend. And the size of the candle body here, the size, provide useful information. Say a long body here, such as strong buying or selling pressure, while a small body and long shadows suggest indecision in the market. They're confused on the future price. In addition, traders often analyze specific candlestick patterns, such as the hammer pattern, which may signal potential trend reversals. A bull market is when stock prices are on the rise or economically sound, while a bear market is when prices are in decline, panic, or in crisis or turbulence. The origin of this expression is unclear, but one reason could be that bulls attack by bridging their horns upward. When they are in fight, they attack by bringing their horns upward. While bears in fight, they attack by swiping their hands downward. So this is called a charging bull, sometimes referred to as the bull of Wall Street in the US, in New York. So this is a very famous bronze sculpture that stands on Broadway. So if you travel, if you have an opportunity to go or travel New York, try to look at this very huge bronze sculpture of a bull in Wall Street. I just put this chart to show that a bull has some symbolic meanings for stock market investors. So if you go travel New York sometime, go try to see the bull. And we have those bull in Korea stock exchanges. And in the past, they had one huge this bronze sculpture of a bull in Daewoo-Jungkwon, but they moved. And currently, we have one bull sculpture in the Korea Stock Exchange in Yeouido. So try to see that bull. It may give you some passion about stock investment or working in a financial market or financial institutions. So far, we have focused mainly on price movements, but technical analysts often look at another very important factor, the trading volume. The trading volume refers to the number of shares traded during a specific period of time, such as a day. Why is volume important? Because volume can provide information about the strengths of a price movement. In many price charts, volume is displayed as vertical bars at the bottom of the chart, of the bottom of the price chart. Each bar shows how many shares, how many shares were traded during that period. So technical analysts often interpret volume as a measure of market participation. Which can indicate the strength of a market or that trend, the price trend. If many investors are trading a stock, it suggests that the price movement reflects strong market interest. So if there is a huge trading volume, it suggests there is a strong market interest. On the other hand, if the price changes occurred with very low volume, the movement may not be very reliable. So for instance, suppose a price suddenly increase. If that price increase is accompanied by high trading volume, it suggests that many investors are buying the stock, which may indicate a strong bullish signal. But if price increases with very low trading volume, the movement may simply reflect a small number of trades rather than a broad market support. For this reason, technical analysts often say a volume confirms price. So if there is a price increase followed by a high trading volume, you can reliably believe there is a high, strong upward movement. But when there is a low trading volume, even if there was a price increase, you cannot reliably believe there is an increasing market trend. So you have to understand why they say the volume confirms price. In other words, price movements are considered more reliable when they are supported by strong trading volume. So for instance, during the early stage of a new trend, say here, early stage of a new trend, trading volume increase often increase significantly. This happens because many investors begin to react to new information or changing market expectations. Therefore, technical analysts pay attention to situations where volume and price move in different directions. For instance, suppose a stock price continues to rise, but trading volume gradually decrease, say the volume decrease. This may indicate that the upward trend is losing its momentum. Here, when there is an increase in price, while there is a decrease in price, we can infer that the price is losing its momentum. Conversely, if prices are falling, let's make it clear. Say prices are falling while the volume increases sharply. This may indicate a strong selling pressure in the market, further confirming the declining trend, which means that price decline may continue in the future. Therefore, a volume analysis help investors evaluate whether a price trend is strong or weak. Alright, I think let's stop it right here and continue from here next week.